All right, everybody. As I always say at the start of these live conversations, please bear with me. I want to make sure that this is streaming properly across my accounts as well as Chris's accounts. This is a live conversation, and yes, we can see your posts. So whether you're on X, LinkedIn, YouTube, watching on my account or Chris's account, and you want to engage, if you want to engage, post whatever questions or comments you have in whatever platform you're watching this on, and we'll be able to see it and try and bring those questions up. Let's make this as interactive as possible. Makes my job as a host easier, candidly. I'm actually excited for this conversation. I've seen Chris do a lot of the podcast rounds and video rounds, especially with my friend, Mr. David Lynn. So he's a great interviewer, and I think we'll have a good back and forth here as far as where we are in the market, cycles, and all that good stuff. So with all that said, my name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the rough hours, Mr. Chris Vermeulen. Chris, introduce yourself to the audience. Who are you? What's your background? What have you done throughout your career? What do you do currently?
Yeah, sure. Well, welcome everybody. And long story short, I've been in the market since I was 16 years old. Got hooked in high school with the stock market challenge, our classroom trying to beat other classrooms across Ontario, which is a province in Canada. And really got hooked into trading during the tech bubble and opened my account with my dad co-signing when I was 18 years old. My first trade was in Palm Pilot with a little phone with the pencil, which I thought was like breaking technology back in the day. And went on holidays, made like $8,000 with my $2,000 account, and I was fully hooked on trading the markets. And I've kind of done full circle over the past 25 years. I've traded small cap stocks, penny stocks, covered call strategies, Forex futures, day traded futures, all that stuff. I've gone full circle to now it's how can I make the most money with the fewest trades and the lowest drawdowns or the smallest risk. And I just use ETFs and I just manage my own money, I share my signals. And everything I do is based around technical analysis. I did do fundamental analysis. I used to buy companies that were growing, and it was all about fundamental analysis until I lost my shirt in the tech bubble when it burst. And I realized even if you're buying companies that have quarterly growth, the share price can get cut in half and then get cut in half again. And I was like, fundamentals doesn't work. So what I do now is I follow price. I don't try to predict or call major turning points and trade off them. I simply let the market turn corners, and I need to make sure there's power and momentum behind them. And then I ride the coattails of the market. So I never have to try and figure stuff out. I'm really just following the markets and figure out which asset's the best one to be in at any given time.
As you know, there are a whole lot of ETFs that are out there. How do you limit your opportunity set? Because let's face it, most ETFs are just variations of beta. And I'm curious to hear your thoughts on, as a trader, using leveraged ETFs.
Yeah, so I keep things really simple. So a couple things. I look at the stock market. Let's step back a couple notches. So the stock market to me moves like the ocean. When the tide goes up, it lifts all boats. When it goes down, they all go down. I was actually just doing a live mentoring session earlier today with our subscribers, and one of them was talking about what about like Germany and Japanese stock exchanges and India stock exchange, all those. So we layered them together, and they all do the same thing more or less. If the US market is in a bear market, so are they. If US is rallying, they all rally. And so a lot of people, what they do is they buy a whole bunch of stocks, a whole bunch of different sector ETFs. As you mentioned, there's like over 2,700 ETFs or something like that, or more now, I'm not sure, but there's a ton to pick from. But it doesn't matter what you own. Diversification among stocks, it's all the same trade. It's just some move up or fall less than the others, but they all move together as kind of one play. So the way I look at the markets and select my ETFs is very different. I look at the US stock market as the SP 500 or the QQQ, which is the NASDAQ 100. And all I want to do is know is if those indexes are moving up and there's power behind them, then I want to own those two indexes or one of them, whichever one fits the criteria better. Potentially we could own both. If stocks are not moving up and they don't meet our criteria of a strong trend and they're stable, then we'll look at a different asset class. So we'll pull out of everything. We only trade the index ETFs, and then we'll move to like the bond ETF, TLT, or potentially the US dollar index or the US dollar inverse ETF. So it doesn't matter if the US dollar index is rallying or falling, we can actually still take advantage of that. And then sometimes we just move to a cash position like BIL, which pays you daily interest and a monthly dividend. No downside risk. You're just sitting on the sidelines, waiting, earning a little bit of interest until there's a new opportunity. And each of those assets, you go from the stock market to the bond market to currency to cash, As we move down, the markets are usually getting crazier and more volatile. And each one of those in this asset hierarchy that I call it is a slower and slower moving asset. So we're moving to slower and safer, more consistent moving assets as the world kind of gets crazy, but we can still pull money out. And just to quickly kind of continue on this ocean wave, think of yourself, or this is what I do. I'm a surfer. So think of yourself walking down an ocean beach. You see surfers floating out past the break on their boards, relaxing, talking. What are they waiting for? They're waiting for that set of waves to roll in that come every 4 or 5 minutes. And the stock market is very similar. There's 5 to 12 waves that roll through these top asset classes I just talked about: stocks, bonds, currencies. Then all we do is we wait for those waves to come, and then we can identify with technical analysis, money flow cycles, how strong are those waves. We hop on the one that meets our criteria and we ride the wave with an ETF, one ETF position. Very, very simple and straightforward. And the nice thing about catching a strong wave is you also know when it's starting to weaken. And so we can start trimming off profits, moving our protective stops up, and we can carve off that wave before it takes you down with it. And that's all I do is we wait for these waves, and we're sitting in cash 35, 40% of the year collecting interest while we wait for a low risk, high probability trade in these 5 different assets that we look at, or 5 different ETFs: SPY, QQQ, dollar index, and cash position.
I haven't heard you talk about small caps, I think for obvious reasons, because there's no strong uptrend there. But any reason why you exclude something like an IWM?
I do look at it. So for example, a good gauge of the markets is if you take like RSP, which is like an equal weighted SP 500 ETF, and then you take IWM and you take IWC, which is the micro caps. That gives you thousands of stocks. So it strips out the heavyweight of the big technologies, gives you the core SP 500 broad market, and then you put the small caps in there, and then you throw in all the micro caps. That gives you a view of thousands of stocks. And that, if you blend those together as an index itself, you'll be like, okay, well, this stock market is creating a very interesting topping pattern. I do love small caps. I do like micro caps, but the environment has to be like it has to be the perfect storm. And it's generally not a perfect storm for small and micro caps. The time will come. I think we're going to see a big market reset eventually. And late this year, maybe the market tops. Next year, I think it could be a bloodbath across most equity classes, including like even real estate and stuff like that. But the time will come when I think precious metal miners and uranium stocks and will come to life. And eventually, in general, micro caps or small caps will do very, very well. But we're just not in the environment. People don't really want those. Money's not flocking into those. This money's still flowing to dividends and big, large tech at this point. And I think we need a financial reset, a cleansing of the markets before they're going to come to life. And that's probably a year or 2 away.
Has the strength of the large cap side been surprising to you at all as a trader? I mean, I think I keep going back to this point that if I were to say to somebody at the start of the year that 2 of the best performing areas would have been gold and utilities, if you knew that, you probably wouldn't have said the S&P would be doing as well as it is this year.
Yeah, the SP 500 is doing pretty nice. I mean, the big tech are kind of holding the NASDAQ down. They're kind of holding it ransom from moving up, where the SP 500 is like threatening all-time highs again. But for sure, like gold, we've been talking about gold for years. If you go back to 2002, 2003, from the bottom where gold started a new super cycle to the peak in 2011, and then down to the bottom back in 2015, 16 area. If you use Fibonacci extension, which is a great way to gauge momentum, gives you an idea of where upside potential targets are, how much momentum gold could have, it comes out to 2,750 for gold, 27 to 2,750. And that is a 20-year price chart pattern. And we've been watching this, and we saw gold break out. It started a new super cycle in 2019. And ever since then, we've had that 2750 target for years, and it's finally at that point. And the fact that gold is rocketing higher, it's doing the same as what it did in 2007. It went dormant for several years, 2005, 2006, gold stocks skyrocketed everywhere. Well, we've just seen the same thing. We've seen gold go sideways for several years. We've got a bubble in every asset class, but now gold's starting to outperform just like it did in 2007. And to me, gold is think of the world, the globe, the planet Earth is like a hive, a beehive. And it's like every investor is like a hive mentality. And when gold starts to outperform and takes the lead, it means the whole hive, everybody's getting nervous. It's a big warning sign that a financial reset, something is going to happen that we don't know what it'll be yet. And we'll call the recession or the correction after it's give it a name after that. But gold is it's doing exactly what it should do. I think most of the upside in gold is done right now. I think there's very little upside left. I feel like we're going to go into a recession. If we go into a bear market, we're probably going to see gold and silver get pulled back very hard, potentially 20, 30% or so, unless there is like a black swan event, like say nukes or bombs start going off and another World War III really kicks in. That is obviously going to be a black swan that spikes crude oil, spikes gold pricing. So there is that side, but gold has moved where we expect. It's done its move, in my opinion. I don't think there's a whole lot to jump into. I think we wait for a reset before you add more to your position going forward. And utilities have been screaming higher. The last time they outperformed the stock market this much was just before the COVID crash. So it's another warning sign that defensive money is looking for these plays. No matter what happens, we need electricity, running water, and that's why we see utilities do well. Plus, they pay a dividend, and if interest rates are going down, it's good for them because they're debt-heavy companies.
I want to go back to what I asked before, which is the levered funds, because as I hear you, you sound more like an asset allocator as opposed to kind of maybe a short-term trader. I mean, am I right in that? Are you sort of in between, and is that why maybe you avoid the levered funds?
So I don't focus on levered. So I focus on managing my own capital, and I don't apply leverage to it. I don't want that kind of volatility in my account. So I focus on the core indexes. The only time, I don't actually trade leverage unless I'm day trading. If I'm day trading, I find a setup or some short-term momentum play. I can do those, but in general, I don't do the leverage. Just I think there's some drawdowns to them. I think they don't quite perform perfectly. We will trade inverse ETFs. So if we enter a stage 4 decline, which is a financial reset like 2008 or the tech bubble bursting, previous big bear markets, we will trade an inverse, but I won't trade the leverage. Simply, it's just not what I focus on, and I just like to keep it really straight up, one for one for the markets. I mean, if you're trading a small account and you're aggressive, then leverage ETFs are great. But if you want to protect your wealth and your lifestyle, and you have a larger amount of money, it's not something I just really throw a ton of leverage at. I want the consistency, stability. I don't need volatility. It's just preserve and grow above average as much as possible.
Go to some of the questions in the audience. This one from Larry. I'll show it on screen here. With today's surprising higher 250K new jobs and lowered unemployment down to 4.1, what asset classes will benefit from the more positive employment statistics that exceed economists' 150K new jobs? Asset class wise, I mean, I think the obvious answer is the right one, which is equities. Clearly, treasuries did not like the news. Although I'm actually surprised that yields didn't go up more personally on the reaction. So any thoughts on that?
Yeah, I mean, everything moved today pretty much as expected. So, for example, if somebody goes to my website and they join my free newsletter opt-in form, I have this economic indicator trading tool. It's just a PDF. It's a one-pager. It says, hey, if unemployment is lower than expected, then bonds will drop, stocks will go up, the dollar will rally, and gold will go down. So I have this for all kinds of economic indicators, and it's a great tool. We're talking about it today, going over it. And it's a nice way to visually see how one piece of economic data runs through all the asset classes, how it's going to affect them. I mean, obviously, if we've got strong jobs, then rates might not get cut, and that's not good for bonds, for bond pricing. So bonds are definitely getting sold off and moving down because now that people are thinking there might not be a rate cut, or there might be only a quarter basis points, or maybe the Fed's actually going to move up a quarter percent, really throw people for a loop. So, I mean, economic data, I don't trade or invest around it, but it is good to know when something moves in one direction, how does it ripple through the rest of the asset classes? I mean, I don't really care what it is. I just follow price action. So I don't have a whole lot to say about it. I do feel like the economy is still weakening overall. It's a little tiny blip of strength. Overall, I think we're seeing unemployment continue to rise. We're seeing delinquencies on credit cards, maxed out credit cards. Mortgages defaulting like left, right, and center. Homes are not selling. It's like mass supply, and just the bottom's about to fall out, where finally people start having to actually give a real discount and bring the house prices down. So we're on the verge, I think, of a very big weak economic time. And I think any strong economic data is really just a little blip on the radar. I think overall the tide is going down for the economy in general.
That's actually a good transition. I think we can have a good back and forth on this, given some misconceptions around my own research. This is a comment also from YouTube. Why are we hearing so many misleading or so much misleading information on YouTube about crisis, recession, but the stock market is still rising? So a couple of things there. One is there's the old adage that the market climbs a wall for you. The other aspect of this is maybe all those people, me included, as I've been concerned about the risk of a credit event, which I've been dead wrong on. And I've been wrong on a lot of things, like a lot of people are wrong on a lot of things. Maybe everyone's just maybe early on that. I keep going back to a lot of people were wrong arguing that the housing top in 2006 would cause a crisis until 2 years later, in which case they were dead right? So let's talk about that, because I think it's interesting. It is true that the negative narrative does tend to sell. People want 100%. To hear, it's part of our survivorship bias, right? It's like if you want to protect yourself as a caveman, you got to be paranoid about everything around you, right? In markets, it's the equivalent of sex sells is fear sells. I mean, let's just face it, right? But let's talk about that, because I think it's interesting that there is a lot of negativity, and I am part of that as well. And look, we've all been wrong. Is it that we are wrong, or is it that the market's wrong, or is it just a question of timing?
Yeah, good question. So yeah, it's difficult. It's easy to have I've been very bearish on the markets for a long time. But there's a huge difference between what we think and feel is going to happen versus what you need to do. So for example, I've been thinking the markets have been topping for a couple of years. I think it's what I've been talking about. Things have been slowly lining up every month or every quarter. Things line up even more and more. And the paint is really getting thick here now that gold has hit a measured move of a major cycle top and all this stuff. And utilities are now screaming higher. There's a whole bunch of things coming together. But the key, I think, for people to understand is you don't invest or trade on what people think or feel. And while I'm super bearish on the markets, we are long the market because the trend is still up. And this is the big disconnect is, yes, I'm bearish, but the trend is up. We follow the coattails of the market. So we identify if the trend is going up, then we're going to ride the market up. And I mean, I have the same thing. I talk to subscribers all the time. They're like, why are we going long the markets when you're saying we're going to have Armageddon, like the end is coming. And I'm like, that's what I'm trying to mentally prepare you for, because one of these times when we have a sell signal and we exit and there's a correction, it's going to take potentially years to unfold and you don't want to be holding. But until then, we have to ride this market up. And that's really the key is follow price. Don't try and lead it. And people always say, well, technical analysis is voodoo. And they're like, you're picking tops, you're a market timer. And I say it's the complete opposite the way I do. I'm not a market timer. I don't pick tops or bottoms. I follow the markets. So I get in after it's clearly bottomed. I never get in near the bottom. And I get out after the top has been clearly put in and the trend is down. So I don't have to do a lot of work other than identify as has this trend come to an end? And do I need out? Is there enough momentum that we need to exit? And that's the big disconnect.
It's also amazing because I think if you're going to be a trader, you almost have to have times where you're bearish. I mean, otherwise just be an investor and be long only. Why?
Yeah, exactly.
It's an odd disconnect. It's like you can't have it both ways. You can't say I'm a trader, but I'm always bullish. Well, then you're an investor. Right? You're not a trader. Right? I don't quite understand the logic there. And I do think a lot of this is about time frames. Now, I always go back to the point that you use the term market timing. Market timing generally doesn't work if you're timing against cash. But market rotations do work because, to your point, there are times when long duration treasuries outperform, when gold outperforms, when the Qs outperform, right? And you're kind of rotating around that. So let's talk about some of the tools that you use to identify where that momentum is stronger, so maybe where it's starting to turn other asset classes.
Yeah, I mean, it looks like bonds are starting to come to life. I mean, we're still long the equities market here, but bonds are starting to come to life. And the big question is, I think, how is the economic data? What's the Fed going to do over the next, quarter or so? That's going to give some good insight, I think. I think the economy is slowly grinding down and slowing. That I think we'll hit a tipping point where we'll be confident rates are going to continue to fall. But right now we're still in no man's land. But bonds, their chart pattern and everything looks very much so like a major bottom is getting put in place. Equities, I mean, we're looking at the NASDAQ. The NASDAQ has about 8% upside potential from where we are right now. So there's still actually quite a bit of upside. The SP 500, I think, can rally about 4 or 5% from where it is right now. So, I mean, right now, I like the equities market. Right now, when we were looking at money flows, where's money flowing and what's going on in the markets, equities is the place to still be in. I think it has the best potential, and there's still some upside left in that. And because we kind of just focus on one asset class at a time, the other ones we don't really care about because we want to take the most volatile one, which is the equities market, if it is favorable. We don't want to go to something really slow when there's a clean signal in equities to go long. So I think equities is still the play. I think there is that huge wall of worry. We just saw that massive correction in August. We saw the VIX spike like 175% in one day, massive gap down. We saw panic selling on the New York Stock Exchange. I have this little indicator that shows us if people are panic selling or if they have FOMO. It tells us usually short-term pivot highs and pivot lows on the markets. And it maxed out as well. So we've had a cleansing event over the past 2 months, really. And now the market is primed and ready for another big leg higher. And people are nervous. I mean, it seems like everybody right now keeps telling me like they're worried to be long stocks. They think the market's falling. They're not acting normal. But really, when I look at the stock charts and everything else, I'm like, it's just normal price action. And the underlying trend is up. Money is flowing in. There's definitely some distribution selling going on. We are looking at on the intraday charts today. There's some huge institutions unloading huge amounts of their portfolio. They keep hitting the market. Every time it gets up to a resistance area, we see high volume. So it's distribution selling. But that's normal. That's just big profit taking from institutions that take months and months and months to unload their portfolios. So it's another warning sign, but doesn't mean the top is in yet.
This is actually an interesting question I kind of talked through off of YouTube from Cavi H. Have you had any sell signals this year in the NASDAQ? I'm asking because I had a 14% drawdown. Surely that must have triggered, and I want to focus on this part, albeit falsely, the sell using your system. If so, when did you get back in? Okay, so I want to broaden this actually to a bigger conversation around type 2 errors, right? False signals that happen when you're more systematic and technical, which goes back to market timing tends to not work because if the false signal results in you being cash, you're missing out on the comeback. Whereas if you're in something else, you at least have a chance at being wrong while making money in that false signal. Have you been whipsawed at all this year?
Yeah, we've had the odd trade that doesn't go against us. So we got long the indexes a couple weeks ago, up near the highs, and then it rolled over and sold off. And we took like a 2% loss on it. Everything is fairly contained the way we manage the strategy. But yeah, when the market is chopping around, which it has, it's definitely been struggling the last couple of months. It can give you some false signals in the markets. We don't hold things when they start to fall. We quickly get out, let the market reset, and we'll move to cash or a bond position during that time. And then once the market does rebound and start to move up, sometimes we buy in at a higher price, but we'll get back in for that next trend. The thing is, we just don't want to be holding it if it sells off 5% and then falls another 5 or 10 or 15% and keeps going. It's much better the strategy that I focus on is protecting capital, and we just don't want to hold stuff. You never know how far something's going to fall. So when the trend goes down, we move out of that asset and we'll move to something else. And lately, because bonds have not been in favor for really years, we've been moving either into UUP, the US dollar index, or into just BIL, collecting daily interest and dividend, just safely sitting on the sidelines until there's an opportunity. But bonds are actually starting to come to life. They could become a very good tool over the next 6 or 8 months to actually have some pretty good upside. When the stock market sells off, bonds could start to rally and come back up.
Speaking about protecting capital, there's another comment here from David on YouTube saying he bought long put options too early. Of course, if it's a long put option, depending upon the expiration date, maybe it's not too early. But since you mentioned protecting capital, do you use puts at all? Do you do any kind of options overlay?
No, I don't do any options. I don't do any hedging. I find options obviously have like time decay. They're expensive. They carry more risk. If you do any type of hedging strategy, hedging is an expense. I'd rather just move out and earn interest on the sidelines versus trying to have a hedge and hold another position. I just keep it really simple and clean. I'm either in it or I'm not. And if I get out of that, I'm hopefully going to go into something that's going up. But I used to hedge and I just don't do it anymore because it just makes things kind of convoluted, complicated. And I just find options in general, unless you're writing and selling options, you're doing more advanced strategies. Options are an expensive way to try and get some, just the odds are against you if you're buying options, period. I don't really care. They're very, very high risk strategy unless you can really nail down moves. Yeah, that's kind of how I move it. I just move to cash.
Talk to me about the kind of people that track your service that follow you. Are they newbies? Are they people that are from industries that somehow got interested in trading but they don't know how to start? Talk to me about sort of the profile of your audience.
Yeah, I mean, there's two core profiles. A lot of them, obviously, I've been running and sharing my trades since 2001, so I've been around for a long time. So I used to focus more so on short-term traders. You asked me before, am I more of a trader or like more of an investor? I'm both, but I'm only looking for these 5 or 12 trades a year. So it's like, it's not buy and hold, but it's not active trading. I'm kind of right in between, which I've kind of termed it asset revesting, which is a book I wrote about last year. It's just enough to catch the waves, the big waves in the market, the sets that roll through every year. But the ideal user, there's two groups. They're either a self-directed trader and they've been struggling forever and they just want to grow their wealth. Generally, they're 45 plus. They have quite a bit of capital, a sizable account, several 100,000 or more. And then there's the other people who are fed up with their advisors and they don't protect them in 2022. And they've been holding bonds since, the bonds topped out during COVID and bonds fell like 40%. And they're moving from their advisor. They have no idea what they're really doing. They don't want to do it. And I provide auto trading. So they more or less have exact trades that I put on executed in their account for them. They don't have to watch or learn or do anything. So then we have total newbies and they're just really learning the markets just from the updates I do throughout the week, and everything is kind of done for them. So there's either the passive investor who's now saying I need to take a bit of control because this is, I don't want to blow up my retirement, because I believe the buy and hold strategy, I believe dividend stocks is like the baby boomer, the retirement's like ticking time bomb strategy. The whole reason I've really started to push this asset revesting strategy, which is what I do, is because I believe we're coming into this time frame here where, so the market is really good at one thing. It's really good at applying the most pain to the largest group of market participants at the worst possible time. And right now, I believe there's more people like 45 plus who have a ton of capital, who are close to retirement, and we have the most retirees ever. And now the market is going to have this massive bubble burst, all kinds of bubbles burst, and it's going to destroy so many retirements. And the key is you need to understand one of these is coming. It's just a matter of time, and you need to have a way to identify it, and you need to be able to either avoid it or even profit from it even better, which is what I focus on. So really, I'm looking at people 45 plus who have several 100K, close to retirement or retired, or millions. I mean, we've got some pretty massive accounts, but that is who I can help the most. People who have wealth, who want to preserve it and keep their lifestyle no matter what happens in the market. I'm not looking for, if you're a trader and you want to make 50% a year and you want to trade sectors and stocks, do all that stuff, knock yourself out. There's a million services out there. But I am looking for people who value consistency, compounding, low risk, simple, logical strategy that just makes sense. That's
I want you to expand on this point about dividends as a ticking time bomb, and also explain the framework of the reinvesting. I'm going to assume that you're talking about, dividend stocks in more speculative parts of the marketplace, whereas the blue chip dividend plays, I mean, listen, if they're going to sell off, the dividend yields are only going to go higher, right? And as long as they are well-established companies that people have products and services people always need, and their valuation is relatively okay, they'll make it through.
Oh, they'll survive. But the way I see it, very different than that. So for example, during COVID, the majority of investors in the US stock market are like 55 plus. They have most of the money in there, and they all have the same bloody positions. They all have large blue chip tech stocks or blue chip dividend paying stocks. When that same group of people all hit the threshold as I can't take this anymore, this is killing my retirement, during COVID, we saw the dividend ETFs and all the dividend stocks, they sold off way more than the SP 500 because it's the same people with the most money dumping and panicking out of the same stocks. So you actually will lose more money holding dividend stocks. And yes, as the price goes down, the dividend goes higher, but you still paid the higher price for them. Or to me, it doesn't matter. I don't care if it pays a 10% dividend. If the thing's going to fall 40 or 50%, I really don't want it. I don't believe in holding something for a small dividend. That the problem is if we go into a recession, and I remember this from last time it happened, you go into the recession and then all you start hearing for the next like year or 2 years is companies cutting dividends. And every time they cut dividends, they get pushed out of funds, huge institutions move out and the stock gets hit. And so I don't see them as a great play because they're actually more volatile than the SP 500 themselves when panic selling hits, when a bear market hits. That is the main reason. I just don't want to hold. That's everybody gets into this whole dividend. Well, it's going to pay me a yield, but they're really volatile. People don't realize how volatile they really are. They're super dangerous, and the whole buy and hold to me is that ticking time bomb that I kind of mentioned before, which is almost all asset classes go down when there is a financial reset. We see home prices go down. We see stocks. We see precious metals go down, I see all kinds of other things like cryptos and stuff. Everything will probably collapse when there is mass panic selling and fear, liquidation, they all go down. So why own a whole bunch of them if they're all going down? Why not avoid them or take advantage of falling prices? And there's no protection. I guarantee if you have a buy and hold strategy, I guarantee you will never retire in your 20s or 30s or 40s. You've got to put in like 40 years of investing. And I guarantee you're going to ride the craziest roller coaster multiple times. And you'll be like, if you remember 2000, you're going to remember 2008. You're going to remember the COVID crash. You're going to remember 2022, which was really nothing. That's, I think, a drop in the bucket compared to what's coming next. The buy and hold portfolio is just going to destroy so many people. Problem is, once the market starts to fall, people will be down so much, and then they'll go to their advisors or check their own account if they're managing it. And they're going to be down so much. They hit this scenario where they're like, well, I'm down too much. I can't sell now. And then the markets just keep going down and down. And they're stuck in this terrible, it happens over and over again. It's just this vicious cycle for poor investors who don't understand the cycles and the stages that the markets go through and how to manage them. So I'm not a believer of holding assets. I don't care if they're high dividend or not, period. If the markets are going down, if the ship's going down, the ocean tide's going down, just move somewhere else. That's the way I see it.
But another question off of YouTube, talk about time frames. What's the time frame you're looking at for the Qs and the S&P to, in quotes, top? I always go back to it's very tricky to time a top. That's why I try to frame things in terms of conditions. But if you're going to guess as far as time frames, how do you think this plays out?
Yeah, this next leg up based on the daily chart pattern, it looks like over the next 2-3 weeks, we might actually see this 5 to 8% rally on the stock market. I think we've got some potential here for a push. Maybe the market always has a way to drag things out. So maybe over the next month, I think we could see this next wave up if we get this leg higher to stall out. When will it officially top? I kind of feel like we kind of need to wait for the elections. I think the market is kind of waiting to see what's going to happen there. The elections throw a real curveball into it. But other than that, I kind of look at short-term patterns and how far they expand out. So I would say 3 to 4 weeks, I think the stock market could be up like, I think 6,000 for the SPY or the SP 500. The NASDAQ, I think, could rally about 7-8% from here. So it's a good move.
Yeah, that would already make it among the better moves for sure, right? That's like a late 90s type of environment. Yeah. Let's talk about the book a little bit, Asset Revesting. What is revesting?
Yeah, so I kind of coined the term. So instead of like you've got the buy and hold and you've got active trading, it's kind of in the middle, asset revesting. So what we're doing is we're reinvesting our capital into whichever asset class is the strongest and the best at any given time. So all we're doing is reinvesting into one asset class at a time, rather in equities, bonds, a currency, or in cash. And all we do is we just rotate through those simple ETFs and manage those positions with stops and targets, scale out. And that's it in a nutshell. I don't believe in diversifying because generally if something is going up, other things aren't performing as well. We want to own whichever one is performing best, has the strongest wave. And then we just want to hold, that one asset class at a time and move to another one once it runs out of steam. So that's forward. People, it's actually so simple and so boring that people are like, it's like watching paint dry. Active traders, because they're like, this is like super boring. But the thing is, almost every month or every quarter, our accounts are hitting new all-time highs over and over and again for, every year. And I mean, that's what people want. But because it seems so slow and boring, because it's controlled, we see trades coming days in advance. We also know when we're probably going to see the trend change a few days in advance. There is no shock and awe type of scenario. It's not active trading. You're getting hit by anything. We see momentum shifting. We see things changing. So we can tell when all this stuff's coming. So when you understand something and when you have a strategy and you have rules in place, it becomes not scary. It just becomes a process. And once you have a process down, you're not scared and nervous. We don't really care what the Fed does. We don't care what the price does. We have strategies in place. We have a plan for whichever it does, whatever direction it wants to go. And that's kind of how we go about it.
You mentioned you started when you were 16 years old. By the way, I have a similar history. I actually worked on the floor of the New York Stock Exchange at 16. So it was kind of interesting that we share a little bit of that. Nice. That earlier experience. You're in Canada?
I am, yep. Just north of Toronto.
Do you feel that being outside the US maybe gives you a little bit more of an edge because there's less noise? I mean, when you're in the US, there's all kinds of shit that's inundating us about markets, and most of the stuff is not actionable.
I would think so. I mean, I don't watch the news. I haven't watched the news for probably 12 or so years. So if there is something crazy big hitting, it's usually my 12 or 14-year-old, my son or daughter come and tell me, like, did you hear about this? So I don't have a whole lot of noise. I don't even read other people's opinions anymore. I do my own thing. I live my life. I keep it really, really simple. There's no doubt. I know in the United States, you guys are like hammered with all kinds of media. So you probably are inundated and it's so close to you that sometimes you can't see what's going on. It blurs gives you that noise and blurs things. But I have a pretty clear mind when it comes to what's going on. I do like being on this side of the border because then I can look in with that cleaner perspective of not being stuck in the middle, but I can see what's going on. It's like watching a fight from the outside. It's pretty crazy. But yeah, so it does have an advantage, I think. Yeah.
But then I'm curious, why focus on just U.S. markets as opposed to Canadian markets?
The U.S. markets, I just find are much more liquid. That's where obviously the most people that I can help. It's what I trade. I also like holding U.S. dollars. I've held U.S. dollars since like 2010, 2011 is where I keep my investment account because I believe the U.S. dollar. I still think the dollar index itself is going to continue to rise. As much as everybody keeps saying the dollar is going to collapse, I mean, I've heard that since I got into trading. Wait for that to happen. I think there will be a big reset. So I still think holding US dollars for potentially another 6, 8, 12 months. I think when the stock market and the reset happens, I think the dollar will have one more big rally and push, the dollar index. And once we see that, I'll probably change my tune and want to convert my money back to Canadian dollars and then probably trade the Canadian ETFs that are, they'll be currency hedged. They'll mimic the SP 500, the NASDAQ, and all those. Because I'll want to hold the Canadian dollar because I believe it'll go up in value as the US dollar goes down. So that's why I focus on the US. It's where the most people are. It's the most liquid. It's the currency I want to be in. It's the people I can help the most at this point. I do focus on, we got a lot of Canadian traders, but we kind of all trade the US right now because we want the appreciation of the dollar.
You have quite a few screens in the background. I'm curious, how often do you trade? I mean, when you're using these technical setups for these different asset classes where you're trying to chase the best performing, it doesn't sound to me like there's that much activity.
No, there isn't. I mean, yeah, like 5 to 12 trades a year. So all I do is I watch, I monitor. Really, all I do is I kind of handhold everybody who's in the markets. A lot of people get stuck into the intraday charts. They want to, if there's a sell-off one day, they panic, and the next day they're super excited. But the markets just make people emotional. So all I do is I help educate and update people what's going on in the markets. And I mean, I don't have to spend my day staring at the screens. My system's fully programmed. It tells me, what to do, and it will alert me if something changes. All my signals are end of day, so I don't even have to worry about a trade intraday unless it's a stop or target. Those can be hit anytime because those are floating orders. But our whole strategy is end of day. So I won't even know if there's a trade until the market closes. And then if there is, I'll issue a trade alert to subscribers in the evening. They have all night and all morning to put in a market order to get in the next day. So it's really, really passive. It's not about trading. I mean, the reality is the more you trade, the more likely you are to lose. And there's a whole bunch of studies across North America, Taiwan, Brazil that show if you're an active trader and you trade frequently for 300 days, 97% of people lose money. And I mean, a perfect example is I can have trade alerts and signals here. And we just had it. Instead of moving out of a trade for a small loss and moving into a new trade, people just say, well, I'm going to hold on till it goes up. And then they take a huge loss. It keeps falling because they just refuse. So you can even give them winning trades or what they need to succeed, and they'll still ruin it, right? And that's the reality of it. And so that's all I do is I try to help people understand the realities of trading. You have to follow and have systems and money management. You can't just trade off your gut because you don't want to take a loss. Just take the loss. I always tell everyone, and I say, listen, if you got out of the trade where I did, and say we take a loss, a small loss, I'll be like, congratulations. Like, you are actually managing your money. You have self-discipline. You are way ahead of everyone else. There is nothing wrong with taking a small loss or a loss period to cut your losses. It's all about protecting it. They won't take a 1% haircut. Instead, they're going to risk it, and then they blow up their account over one stupid trade. Emotions is like the biggest killer. It's painful.
So what you're telling me is all these traders on X are not actually making the money that they claim to be? Is that
Probably not?
No, I say that. I mean, listen, I'm a portfolio manager myself. With rules-based approaches, right? And that need a particular cycle. And, it's like everything else. There's some cycles where a very active approach can work better than a passive approach, and vice versa. Passive has clearly worked much better if you're just the S&P. But it is unequivocally true that most traders are discretionary. Most traders massively underperform. Most traders think they are better than everybody else. And most traders end up going broke.
Yeah. There's no doubt. I think one of the big things is a lot of us who move into the space are very, very savvy, very skilled, highly, educated, professional, very dedicated in our space outside of trading. You bring in these entrepreneurs and these super sharp people, professionals, and if you are a hardworking person, you want to make stuff happen. And so entrepreneurs, for example, come into the stock market and they're like, I'm going to make a ton of money. And they hunt for trades. They find trades. They think they can make trades happen. The reality is you realize you have to sit back and let the trades come to you. And that's like my whole philosophy is let's just sit back, float on the boards. Let's let the wave come to us. If you go looking for a trade, I guarantee you will find one. Will it actually be a trade? It's probably your brain convincing itself I'm tired of looking. This is good enough. And that's what people do, right? So, the more you trade, the more damage you do. You really have to learn to sit back and really kind of follow the markets, take advantage of the waves and the tides, not trade the chop and the noise, because it is a very, very difficult battle. And us as entrepreneurs, we want to make trades happen. We want to find trades, but having a bunch of scanners and tools and firing off trades all day really isn't the solution. I mean, some of us have some pretty good tools to do it regularly, but it's a job. I mean, I used to day trade. I only do it now just for a rush on a huge volatility day. I'll do a trade usually at the closing bell in the NASDAQ or SP 500 futures. That's my favorite trade. And other than that, the last thing I want to do is stare at a screen all day. I'd rather, do something else.
Let's talk about the doing something else. I think it's important for people to have either side gigs or hobbies or things that take them out of the market, just mentally. Right? I actually had a interview earlier with Jerry Dillian, and we were talking a little bit about mental health, because in this business, I think people underappreciate how much it can. I'll say the word, it fucks with people's minds, right?
Totally.
Meaning, no, really. I mean, in the sense of think about it, right? You're getting these dopamine hits from the gains, and then you're getting the cortisol rises from the losses. So your body's biological state is always in this flux and hitting extremes, and that's extraordinarily stressful over prolonged periods, right? So how do you unplug? How do you take yourself out of that?
Yeah, well, I think you need to accept. A lot of people don't understand money management, position management, as I'm sure you can agree with. People pick a random amount of money they put in, and then when it takes a loss, it goes the wrong direction. They lose way more than they thought. They can't stomach it. You really need to understand how to manage positions and risk. You're always better to have a smaller position than one too big. I mean, I have a lot of different hobbies outside. Like I'm big into real estate. I own multifamily. I have a self-storage facility, but those aren't so much hobbies. Those are just kind of passive income. I'm involved in a movie. We were just over in London, UK, as keynote speakers at a big clean tech and climate summit. We're weaving in clean technology and climate story into a family adventure movie. I also invent stuff. I invented the world's first flying jet surfboard. I patented it. I licensed it out. And now I'm working on a new invention with a bunch of engineers and a professor from University of Victoria in BC. Something that was totally new. I believe I can break the code. I'm actually going to be trying it this weekend. First real prototype testing. So I do all kinds of different stuff. I mean, I play paintball. I used to play professional paintball. I used to compete horseback riding. Now my daughter does horseback riding. I've got 2 kids, so that sucks up a lot of my time playing with them. But yeah, I think you got to have, I have a machine shop in my basement, so I can go down there and machine and make parts. I really find peace just in the last year. I'm not really good at precision work whatsoever. I'm like the MacGyver, a hack, but I can build prototypes and get a theory and test it. But I'm finally at the point now that I can machine parts, and like first time I put them together, they actually fit like perfectly and everything threads in and locks. And it's like, so there's so much satisfaction. The dopamine hit on machining a part for like an evening and then putting it together and it fits is like, it's like picking a bottom in the stock market. It's like one of the best feelings. So it's, you got to definitely have things you love doing.
Yeah, I think it's underappreciated that, we get so focused on markets and not realize that we have to get outside of markets just to be able to live long enough to see markets come our way. Right. I think it's the way to say it. Chris, for those who want to track more of your thoughts, more of your work, where would you point them to?
Yeah, they can go to my website, which is thetechnicaltraders.com, or you can go to YouTube, type in The Technical Traders, and I'll pop up there. That's or Twitter, or I think The Tech Traders. We have a Facebook, but the website's the easiest. Everything's there. We've got a blog, I share videos, post talks and interviews about the markets and stuff. I mean, one also thing that's really interesting, Michael, is personality. So I did this article on personalities, and if you know your personality type, so you're probably familiar with the Myers-Briggs personality test. So there's 16 personality types, and I wrote a kind of a white paper on this, talking about how there's 16 personalities. 13 of them don't bode well for if you manage your own money, because you have an F in it, means you're sensing or feeling. And there was another report. What sparked this was I was reading another report from some stats, some bureau, saying how 81% of people run out of money in retirement. I was like, holy crap, that is a really huge group of people, and that really sucks. And then I happened to be doing this whole personality thing. I'm like, holy crap, 13 out of 16 is 81%. And I'm like, wow, that makes sense, because 81% of the personality types don't bode well. So all these people have these sensing and feeling personality types. They're like, oh, I feel like the market's topping, I don't want to get in, or I sense something bad's coming. And some of these people have both of those in their initials, in their personality types, which is not a bad thing. There's nothing bad with those personality types, but it just means you're like hypersensitive to sensing, to emotions. Where I'm an INTJ, which I'm like considered the scientist or the architect. I'm all logic. I'm completely strategic. All stats, just like data. I'm just like super dry and boring. Give me what works. I need a system and process. So if you have one of these personality types with an S or an F in it, there's 4-letter initials you'll have, then you definitely need to get help. You need either an advisor who knows how to manage money, or you need a strategy to follow that allows you to navigate these markets so you can follow them. But I have definitely noticed that even if you have that personality type and you're getting the trades delivered saying just buy this ETF, you still don't, it's very difficult for them to still do it. And that's what we're seeing is people like, I didn't get out of this trade because I just didn't want to take the loss, or I didn't get into this next trade because I'm worried the markets are going to top. I mean, emotions is a killer, but if you learn your Myers-Briggs personality test, it really tells you a lot about yourself. And you can share with your friends and family, coworkers, so they'll understand how your brain ticks and how you perceive and how you feel when things happen, which is pretty powerful. And I think understanding your emotions and how you deal with stuff, because you're always going through this cortisol and dopamine hit constantly through life, and the markets amplify it. It's really important to understand that you're going to go through these waves, but you need to be able to like bring the extremes down and be really flatline. The markets generally don't make me nervous at all anymore. I really don't care what happens. We get into a position if we're in a losing position, it sucks, but it doesn't make me have fear. I don't, I don't have that feeling. I'm numb to it. I've lost so many trades. I blew up 3 accounts initially to get here in my 20s. And so I know what it's like to lose money and blow it up. And I just realized losing trades is part of the game. It's just keep them controlled and contained. Yeah.
Everybody, please make sure you follow Chris Vermeulen. Very refreshing, by the way, Chris. I will say. I mean, I think a lot of people that are in markets are. I interview a lot of different people, and there's things that I fundamentally disagree with. But as a host, I listen to them and try my best to try to have an interesting conversation. But I think a lot of what you said, keep it simple, is sort of the main takeaway that I get from hearing from you. So everybody, make sure you follow Chris Vermeulen, check out his work as well, and I will see you on the next episode of Lead Lag Live. Appreciate those that commented on YouTube on my channels as well as Chris's here. Thank you, Chris. Appreciate it.
Thanks, Michael. Pleasure. Take care, everyone.